Okay, RILA's part two, picking up where we left off. Um, so we went through the 1 year buffers, caps, and participation rates. You can also invest over 2 year terms and with the same 20% downside or 10% downside buffer. So same thing. The return or the loss over 2 years would be cumulative. So the return is a point to point year one versus 2 years later. So the total loss protection would be 20%. So if the market was down more than 20, same as the 1 year, is just over 2 year terms. However, the cap rate's a little higher. Sorry, I'm switching back and forth. That was the no fee version. I'm going to go back to the fee version. We'll get back into that in a second. But the 2 year fee version has a 20% buffer and a 45% cap over 2 years. So the most you could get if you put $100 in would be $145 2 years later. And the participation rate again is 100% on that one. You'll notice here on the 2 years, you'll start seeing that the um, caps are higher. In fact, some of them have no cap. That means whatever the index earns, you're going to get the entire return of the index, and you're going to get participation over 100% on some of these. So you can see that we're getting pretty nice returns on 2 year terms. The 6 year is very interesting, and if you consider the fact that a lot of folks are just going to have their money invested basically in a major market index over the next 6 years, here you could do an S&P 20% buffer, no cap, and 110% participation rate. So if over the next 6 years the market went up by 100%, you're going to get 110% of that. And vice, you get the gist of it. Or 10% caps with a little higher participation in these. So very interesting. So we could literally say, hey, you can manage money in these major market indexes. If the markets are down, you're going to get some protection, no cap on the upside, and higher participation rate on most of these options. So why in the heck wouldn't you do this? So um, in general, annuities, two downsides or cautions on our use of RILAs or buffered annuities. In general, any annuity, when you take money out of annuity, they're tax deferred while the money's invested in them. But when you take money out, they're going to be subject to ordinary income tax rates as opposed to capital gains rates. So a lot of times we don't use them in taxable portfolios. We do, however, use them in IRAs and 401ks. So qualified accounts where it doesn't really matter. Any money that comes out of a qualified account ultimately is going to be subject to tax anyway. So we haven't changed the tax characterization. The other thing, you're actually getting only the price participation of these indexes. So if you were invested in an S&P like portfolio with individual securities, you would actually get part of your return would be price participation and part would be dividends. Now, the S&P doesn't have very high dividend rates, neither does the NASDAQ. But you aren't getting that any of those dividends. So that would be a downside. So we would compare this to say, hey, do we like the downside buffers and the no caps and participation rates over 100%? And is that enough to justify to be a worthy part of the portfolio? And so, generally speaking, clients like this, and we're able to blend this in with traditionally managed accounts, alternative investment accounts, et cetera. And again, this one is a 95 basis point flat fee. Um, I'll just hit on Athene actually has a no fee option as well. And you can look at these two rate sheets, and the big difference is the fee version has higher cap rates and higher participation. So if you just compare those two, if you'd rather not pay anything at all from a fee perspective, then you can do this no fee option. You can see there are still some caps. They're relatively high over 6 years or 2 years, a little bit lower on the 1 year. Participation rate still 100, so there's no bonus. But if you'd rather not have a fee, you can do this. We don't care either way. So uh, most RILAs on the market today are 6 year products. There's a declining back end sales charge if you got the money out within 6 years. So our clientele are looking at these are kind of moderate term holds. We're going to use these as part of the overall portfolio and give us some protection in the event the markets do suffer in the short terms. But over time, we're not giving up much, if anything, on the upside. That's where these fit. Really good in IRAs, 401ks, those tax deferred accounts. Um, just be cautious if you're looking at using them in taxable accounts because you will be changing the tax rates. So, a handful of carriers. We generally use Athene. There are a couple others with different index options and different structures, but Athene has the highest participation rates, excuse me, highest cap rates on the market. So, I will go to this is a open website, the Athene Amplify 2.0 series. This is open to investors and advisors, whoever. Got some really good videos, talks about the product. There's kind of walks through the whole thing. You can see the 2.0 is the fee version. The NF means no fee. Very similar product brochure, product guide, current rates, and prospectuses. And then what I like is this calculate your potential. It's a great little calculator. Let's say we put $100,000 in today. Let's just be simple. Let's just say we put it in the S&P 500, 10% buffer. Let's just say we stuck it all in the 6-year option, 100%. And this little calculator is pretty slick. This will tell you, based on the most recent 6-year period of time, you can see that there would have been a 147% increase on this index. This is let's see, 6 year. So that was the most recent. The S&P 500 price return was actually about 134%. You can see it year by year here. And you would have gotten in this contract 161% in total. So you actually would have outpaced the price return on the straight S&P over that time period. It'll also show you the best 6-year period. I think this goes back about 25 years. So it's not the end all, but it does show you. Oh, the best period, S&P was up 208. This one was up 250. So really good. Worst case. Oh, wow. Let's look at that. Oh, okay. 2005 to 2011. You can see what the S&P did during those time periods, started going down, 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 and then up and then down. The S&P actually was down 10.4%, and this you would have been down 0.4%. This had the almost 1% fee, so effectively you lost 6% instead of 10.5%. Keep in mind, though, most investors are paying advisory fees and mutual fund expense ratios on their investments. This is just showing the true S&P. So, and then you can do other years as well. You can also update your selections, put any allocation you want in there, kind of see how that is performed. Okay. So, uh, great products, great diversification. They also take away some of the problems when people are trying to get money invested is they just don't invest because they don't know the proper time to get invested. And see, we say, hey, great. You know what? You've got 10 to 20% downside protection. You might as well go in the markets now. Get in the markets. Most of the time, being in the markets is what's going to get you the returns and get you where you need to be. So, buffered annuities, otherwise known as RILAs, they are a type of variable annuity. Let me know your questions. I hope that helps. Thanks.